Good morning from the Asia Pacific. It's just 9 a.m., half an hour after the opening bell in Hong Kong, Shanghai, and Shenzhen. You're watching the China Show. I'm David Ingles with Robeco Choong.
Good morning. Our top stories today. The bond sell-off spreads to Asia after that hot US CPI print adds to bets that the Fed won't have much room to cut rates this year.
Now, Chinese stocks back in focus amidst this AI-driven rally prompting a rethink of the market's attractiveness. We'll get the views this hour from BofA Securities.
Also ahead, President Trump says he and Vladimir Putin will negotiate an end to the Ukraine war, reversing U.S. policy over the conflict.
Plus, we'll look at whether China's $6.8 billion support plan is enough to plug China Vanke's funding gap and restore confidence in the overall property market. Right, welcome to the show and a very good morning to all of you again. Hope you're all well. We're coming off, of course, a fairly hot CPI print out of the U.S. As far as treasuries go, 2s and 10s are still a little bit lower right now, but certainly not a reversal of any sort and any close to what we saw overnight in that melt up in yields. That's exactly what we're seeing right now across the APAC bond markets, with the Japanese 10-year yield now back to the highs here since 2010, close to 1.4%. Although the read-through across equity markets is one that seems to be largely undisturbed, up 0.4% on the Asia Pacific Index. We're flat at the open in Taiwan. ASX 200, Japan is, and we'll talk more about Japan in a moment because we are in the thick of earnings season there, and of course with some of the big car makers in focus like Honda, for example, today. A couple of other things, iron ore and oil, by the way. There we go, we're back below 75 in the most active Brent contract. Following news here of this phone call between President Trump and President Putin, opening the door there perhaps to a path towards ending the war in Ukraine. Flip the boards, please. The overnight session, as it pertains to Chinese equity markets, is a Golden Dragon Index that is now within a sliver of coming into a bull market itself, 19 and change % up from the recent bottom. A couple of big movers to tell you about: Baba, Baidu, and Bilibili, up in the order of 5 to 6%. And this really takes us into what we're watching today as far as the Chinese markets go. We're also very close now to taking out the October high on the HS Tech benchmark, also with shares of Alibaba here in Hong Kong. So in fact, if you measure things from exactly this time last month when the market bottomed, the Hang Seng China Index is in fact the best performing major benchmark in the world over the last 30 calendar days or so. Dollar China, as you can see, now has a 7.3 handle. That's really on the back of the stronger dollar story overnight following that hot CPI print. Speaking of, the data overnight certainly spurring bets that the Fed won't have enough room, or won't have room at least here, to cut interest rates this year. The one and the only one that's priced is actually towards the end of this year. I think it's towards November of this year. Hot CPI print just about across the board, and certainly spurring those bets that the Fed might not, in fact, be able to move anytime soon. Yeah,
that's right, Dave. I mean, higher for longer looks like it's getting longer. And interestingly enough, we have been having discussions this week with various guests say, you know, market might have become a little bit complacent over what's happening with the Fed. And of course, there's also the tariff story. I mean, so much uncertainty in what we see there.
Yeah, and you know, I think two of our guests yesterday had pointed out that one, they might not even move at all this year,
right?
And the other one, without going into names here, talked about, start to entertain the fact that the next move might actually be a hike. Could be a hike.
Could be a hike.
Not anytime soon, of course, but it's certainly something to consider. 1302 right now on the U.S. Bloomberg dollar index, and of course we did hear from the Fed chair as well.
Yes, yeah. I mean, let's take a listen. So we did hear Jerome Powell saying that the latest CPI data is going to show, or does show, that there is still more work to do when it comes to inflation. Let's just take a listen.
We're close, but not there on inflation. And you did see today's inflation print, which says the same thing. I mean, we've made great progress toward 2%. Last year, inflation was 2.6%. So great progress, but we're not quite there yet. So we want to keep policy restrictive for now.
And let's bring in Alexander Treves, Asia Equities Investment Specialist at JPMorgan Asset Management. Good morning, Alex. Nice to see you.
Good morning.
What do we do with this information? That's it's hot CPI for now, and the Fed might not move for now.
Well, so the most interesting thing for me from that clip was what we didn't hear, which is, it was a very backward-looking clip, which is this is what inflation has done, this is what CPI has done. But what must be on his mind is, if there are more tariffs for the US, what would that mean for inflation? Because, of course, tariffs would be inflationary for the US economy, and that's not something that he really wants. But it seems to be such a central pillar of US government policy right now. So what that then means for the region is, first, of course, higher rates aren't particularly good for risk assets, so we just have to sort of live through that.
Yeah.
But the other thing, if we think about the biggest economy in this part of the world, is one of the reasons we think that China hasn't been stimulating more aggressively is because they want to watch what comes out of the US first. They want to be able to respond to policy out of the US. And so all of this is connected.
To what extent are you seeing this US exceptionalism story kind of sticking through and playing through this year? And just explain a little bit where China comes in here. Of course, this big tech rally that we've seen perhaps changes the dynamics.
Well, I hope so. No, US tech exceptionalism is fascinating because this is one of the few industries in the world that I can think of where people get excited by buying things which have already got more expensive. Most of us, when we go shopping, we want to buy things which are cheaper. But that somehow isn't the case for the US equity market. So, of course, there are lots of fantastic companies in the US, but it's also quite an expensive place to invest. So that's maybe the first thing to say. The second thing to say is that people talk around policy, which of course is part of this exceptionalism story, as if it's just something that the US does to other people. But I don't think that's true. Other countries can impose policy on the US, but moreover, there are implications within the US of its own policy, and tariffs would be the obvious example there, which is you can impose tariffs on other people, but if that results in a rising cost of goods for your own population, there will be unintended consequences. And if there is then a countermeasure from whichever other country, there will also be consequences from that. So I think that risk is something we need to take into account. And then maybe just the final thing I will say is around AI and Chinese innovation and things like that. And the market goes through periods of optimism around China's ability to innovate, and it goes through periods where the market is less optimistic or more pessimistic. And what we saw in January was just this sort of electric shock, this wake-up call that China can disrupt things still. It can do things cheaper than the US in certain areas. And that's really kind of sucked some of the oxygen out of this story in the US. When things are expensive, in the absence of the fundamentals, if the fundamentals change, you don't have a lot to fall back on. So, I mean, ultimately, we need to diversify. We need to accept that it's not the US or any other market. It's both, and we should have a foot in both camps. But I think that the exceptionalism story isn't one that I would rely on.
Okay.
Well, that brings up a good point, because it seems the narrative is it's a zero-sum game on the AI play, right? Investors need to choose between, do I lean into Mag 7, or do I look at this other part of the AI conversation, which are trading less than half the the PEs of Meta's up 18 straight days, for example. Do I need to pick between the two, or can I lean into both AI plays across both sides of the Pacific?
Sure. So we've got a very robust internal debate around what all of this means, because it's not entirely clear to us how to monetize AI as a service. In a lot of cases, I was like, how do we make money out of that? Where are the revenues? Where are the earnings? Which ultimately is what supports share prices. But of course, a lot of the nuts and bolts, or the picks and shovels which facilitate AI, all of that story is still valid. And if AI gets cheaper, and it encourages edge AI, it encourages a smartphone replacement cycle, or a PC replacement cycle, because it means that people are going to buy more devices that can accommodate their cheaper AI. Well, that's very, very good for tech hardware in this part of the world, for example. So we think that a lot of this needs to sort of play out and the dust to settle. But what it means for North Asian tech is probably quite positive still.
To some extent, though, I mean, to David's point about this need that perhaps we feel to pick between one or the other is part of the story about sovereign AI and the national security risks that may be perceived on both sides about adopting, US tech or Chinese tech. I mean, to what extent do you think that is a risk to your base case, or how do we think about what happens when national security starts to really have a read through AI developments?
Sure. Okay, so I think we need to accept that some sort of geopolitical push and pull is something we'll be dealing with for as long as we've all got careers. It's not going to go away anytime soon. And I think it'll be more intense potentially over the next few years and over the past few years, although we should remind ourselves that the US in the previous administration was really quite tough on chips out of China, for example. So it's not a new thing. As for picking and choosing, although it's great to talk about geopolitics, and although some of this stuff really does matter, ultimately at the stock level, normally it sort of blows through in most cases. And if you can find companies with the usual laundry list of things, it's the right competitor advantage, the right business model, the right strategy, the ability to execute, and a clearly defined market, I'm not sure that geopolitical shifts in who can sell what to whom will really impact that. And a lot of these US companies are restricted in what they can do in China already. We know that. And a lot of Chinese companies are restricted in what they can do in the US. The majority of our China exposure for years now has been Chinese companies selling things predominantly to Chinese consumers or businesses, and that won't change.
Okay. Outside of the main item on the menu, which is clearly AI, anything else that's piquing your interest right now?
In China, well, for sure.
Anywhere else?
Anywhere.
Yeah.
Well, of course. I mean, the Japan story is a really, really interesting one. The reshuffling of supply chain through the region, that's not going to go away anytime soon. And people forget that the US stopped being the major export destination or the biggest export destination for China some time ago. ASEAN has already taken a lot of the sort of the lead there. That's not going to change. And then, of course, we've got this other major economy in the region, India, which for a long time was this fantastic fundamental story, which just looked too expensive. Sounds a bit like maybe parts of the US market, to be honest. And then in the fourth quarter, when some of the good news went away, the valuations couldn't really be supported. But that's an opportunity to buy into some of that weakness, potentially, because the longer-term story there is incredibly robust.
Okay. So what looks attractive there, just a final point, on India, because that's a market, obviously, that's pulled back. And, people talk about, China plus one ASEAN. Outside of Singapore, the ASEAN equity market's just been in a terrible place.
They had a tough year. That's true. A lot of ASEAN had a tough year. But I think that, when you're putting together portfolios, you're diversifying assets for the longer run. You're going to have to accept or accommodate some of that in what is a volatile asset class. But again, the underlying story, if the story is still intact, for example, for Indonesian financials, high-quality Indonesian financials, right, or for maybe some, Thai medical tourism services, or for consumption parts of the world, or even still for energy supply in Malaysia to data centers, which can't be sited in Singapore anymore, and they get cheaper, well, that's something that we should celebrate rather than something we should wring our hands about.
Okay, more celebration. Thank you very much, Alex. Alexander Treves, the Asia Equities Investment Specialist at JPMorgan Asset Management. And still ahead, President Trump setting his sights on stopping the war in Ukraine. We get you the details of his call with Russia's Vladimir Putin next. And we are counting down to the open of trade in Shanghai, Shenzhen and Hong Kong, about 17 minutes off there. Keep with us. This is The China Show. President Trump says he's agreed in a phone call with Russian leader Vladimir Putin to start negotiating an end to the war. It reverses 3 years of US policy on the conflict, with European officials getting no advance warning of the agreement.
I'll be dealing with President Putin largely on the phone, and we ultimately expect to meet. In fact, we expect that he'll come here and I'll go there, and we're going to meet also probably in Saudi Arabia. The first time we'll meet in Saudi Arabia, see if we can get something done. But we want to end that war. That war is a disaster.
Derek, we had heard from President Trump that this was going to be, if not the top priority, one of the top priorities. He's frequently reiterated that this war would never have happened if he was president. Just lay out why it's so significant that we are now getting this call between Putin and Trump.
Well, I mean, it is a total reversal of how the U.S. has operated when trying to find an end to Russia's war in Ukraine. For starters, Joe Biden didn't talk with Vladimir Putin basically at all once the conflict actually began. Right. So this idea of direct engagement is very different. As you mentioned, Trump didn't give his European allies a heads up on this. And that's really significant, particularly since J.D. Vance is in Europe right now meeting with European leaders. Pete Hegseth is over there. There are others who are sort of going around doing the tours, talking about U.S. priorities. They did not give a heads up that this was coming. Trump has said he's going to be front and center in these talks. And it's not fully clear what the outcome of this is going to look like. Trump wants a deal done. He's not necessarily suggesting that the U.S. is going to have lasting skin in the game in terms of enforcing any such deal. The other thing that I think really will have taken European allies aback is that Trump's defense secretary, Pete Hegseth, came out and suggested a couple of things as to how this could resolve that amount to pretty substantial American concessions when dealing with Putin. Among them, that Ukraine probably won't be in NATO, that Ukraine probably will have to deal with territorial givebacks. So not only is the move done without a ton of consultation with the European allies, who will have to shoulder a substantial burden in terms of any sort of post-deal peace enforcement, it was also done, I think, in ways that many of them have found objectionable.
Derek, thank you so much. Derek Wallbank there, our senior editor in Singapore for us. Your renminbi fix for today is out, about 1,400 pips stronger than expectation, 717.19. Of course, we're waking up to an extremely strong U.S. dollar this morning, and we should be looking at a Hang Seng Index later. That was what it did yesterday, 2.7%. So do we continue this massive run? Now, futures, bottom of your screens, pointing to that likely being the scenario. 12 minutes away, the opening bell. This is Bloomberg.
It's a very full day in China, and to Dave's point earlier, we're really just watching whether or not this rally that we've seen in shares in Hong Kong can be sustained. Now, the first three items there, they're all related. We are seeing this big rally in stocks in Hong Kong, fueled by these bets on China AI plays. Also, of course, Alibaba. Those shares have surged 46% from that January low. It does mean the HS Tech is near that October peak. 5387 is the level that you are looking to watch there. And then the story that, hat tip to David here, this premium between A shares and the premium that A shares typically have over H shares, now at the narrowest since May. And it's because of this very concentrated trading that we are seeing in just a handful of Hong Kong listed names. Dave?
Yeah, I think that premium is now at the narrowest, right below the 5-year average, I believe. We'll talk more about that later. Yeah, and a couple of other things on the deck today. And, of course, Wang Yi is in the UK. We're watching that very, very closely, too. Yeah. Right. Now, amidst the sort of AI frenzy that's taken hold across some of these names, just a couple of things to tell you about here. Some bullish calls are out of the markets right now. Equity strategists at Morgan Stanley expect the momentum to continue near term. Laura Wang and her team about 2 days ago put out a note. In our inboxes yesterday, James Wang and the UBS folks have come out and say we're probably less than halfway through the current run. And at JPMorgan, strategists say another tactical rally in China is driving upside in Asian stocks.
Yeah, that's right. I mean, meanwhile, Bank of America Global Research says DeepSeek's rise to fame could have the same impact as Alibaba's 2014 IPO. That moment, more than a decade ago, inspired the creation of new economy companies, created broad-based optimism, and attracted billions in foreign capital. Now, here to discuss their latest report is BofA Securities China equity strategist Winnie Wu. Let's start with that. Just lay out the thesis here, I suppose.
Yeah, we think, DeepSeek could be potentially an inflection point for the China market from a 3-5 year perspective, right? So it could be a structurally very positive thing, because for the past few years, what were investors frustrated about or worried about China market, right? Short term is the concern about property downturn. Is that leading to Japanification, hard landing, financial system meltdown? I think that concern has gradually faded away, right? But for the past year, it's also deflation, overcapacity, all your new economy sectors like EV, solar panel, are they going to be really the real growth driver? Can they create enough jobs, right? Because advanced manufacturing doesn't create that many jobs. So concerns on deflation, on the sustainability of export driving China's growth is another big concern. So come back to the question long term is, what's going to drive China's growth and productivity. If it's not property, if it's not export, what's going to drive China for whatever 3%, 5% GDP growth? But since 18 months ago, we've been saying that, hey, this cycle may look like 10 years ago, right? Between 2011 to 2014, global investors also were very frustrated with China market. MSCI China was bouncing around 60 level for 5 years, no performance. And what drove the China market turnaround in 2014 to 16 was one, policy stimulus, right? Rate cut, property easing. Second, structural reform. There was the LGFV debt swap, and there was the supply side reform. But most critically, there was the rise of mobile internet technology, the internet sector. For global investors, this was a brand new, investable new economy sector that brings back long-term capital back to China, not just to play a policy stimulus, but really there for a 5-year growth story, right? And the final critical point of technological breakthrough is the harder one, because policy is within control of policymakers. But technological breakthrough is not something you can predict. It's not linear. So we've been waiting to see, is that going to happen? Is that going to happen soon enough? Especially this time, the bigger challenge is, the technological decoupling, right? The export controls by US. Can China still achieve that kind of breakthrough? But I think with DeepSeek, suddenly people are re-evaluating their assumptions of, China will be left behind in the AI era, right? That the whole AI development will be dominated by a few US tech giants. So I think DeepSeek showed the possibility of China's continued development in the AI era. It shows that China's private sector remains to be very innovative and competitive. And I think it potentially showed that China could take advantage of AI to drive productivity gains, to drive growth, drive prosperity, and bring back the long-term capital.
Yeah, and what reminds me about 2014 to 2016 is, Baidu, Alibaba, Tencent, and the question is, do we pivot back to those old school tech names? More with Winnie Wu coming up out of BofA Securities there to take us through the rest of her thesis there on this AI play. Speaking of, so SMIC is really part of this, right? And the company came out with earnings 2 days ago, and the street's all over this, really. Take a look at its price targets, right? So you have Goldman at, this is the renminbi, this is the A share. So BOC is at $50, JPMorgan's at 32. Yeah, one or two others on the streets on the 8 shares calling for a 60 handle on this. So fairly mixed. Based on good set of earnings, good outlook, but the stock's quite expensive, relatively speaking, of course. We're up 2.1% though in the early goings. Speaking of, that's really one of the stocks we're tracking here today. Yeah, the other one here is this Chinese property name, Vanke. If we can just bring that up on our screens. Quite a rally that we've seen in the shares, and it's really about this sort of vouch of support that, it's down just a touch now, 3.3, but it's really the story about the state coming in to save Vanke in a way that is actually relatively unprecedented in this crisis so far. Anyway, we'll keep watching that. Stay with us. You're watching The China Show. Good morning from a rather grey Hong Kong. Welcome back. You're watching The China Show. Markets are anything but grey. We're seeing quite a busy day already. It looks like the question really is whether or not we see this sustained momentum in shares in Hong Kong, where really is a handful of names that are driving this move, and it's the AI rally, of course, Dave. Yeah, it certainly is. I mean, Alibaba close to $120 overnight. And certainly we do have a 3-digit handle on the 8 shares as well. Interesting timing here, to Rebecca's point in the grey weather. The folks at Burberry have actually dropped this thing in my inbox today. It's always Burberry weather. London in love. Anyway, I'm just reading that out right now. It literally just fell into my inboxes today. Watch your phones, though, so keep that phone in your pocket. 0.5% to the upside on Hang Seng. A50 futures are down. Mainland markets are coming online against the backdrop of an equity market in the Asia-Pacific that seems unperturbed with the hot inflation print, which came through the U.S. That's really more a bond market story. The other thing we want to tell you about is turnover. There we go. For a 5th straight day, topping 1.5 trillion renminbi. Margin debt also increasing for a 5th straight day. onshore. The main point, though, of the rally has really been centered around Hong Kong and a few names here, right? So we talked about it at the top of the show. The Hang Seng China Index is the best performing major equity benchmark over the last 1 month globally. In fact, it's going to come up on your screens. The level you want to watch on the Hang Seng Tech Index is coming up shortly as well, and we're currently about 50 points below that level, 48 if you want to be more precise about things. MSCI China at 71. Ooh, who would thought we'd be at 71 right now? Tencent, HSBC, Alibaba, AIA, and Meituan all seeing some gains in the early goings here. A couple of names that we're tracking here. SMIC was up 2-3% in the pre-market. Sunny Optical out with some prelim guidance on earnings, triple digits on the upsides. Well, on both 140 to 150% full-year nets. And of course, we're watching the property sector for various reasons. One is the Fed, and really we import that, so Hong Kong property is in focus there. And of course, on the Chinese side, the mainland Chinese side of things, is really the Vanke story, and really pulling back after what was a stellar afternoon yesterday for the stocks. We're pulling back a little bit right now. The bonds bottom of your screens, and at those prices, we're actually effectively double than about 3 or 4 weeks back on those prices. So people did come in at about the 40s level and currently bought things up. So yeah, more in the Vanke story, I think, in about 10 minutes or so. We'll go into that story later on.
Yeah, I mean, first, a quick look, really, at some of the headlines in China's official media that we are seeing and reflecting some of the big stories that we have been talking out through this week. Xinhua news agency touting China's attractiveness as an investment destination amid rising geopolitical tensions and trade protectionism. So the commentary says that foreign investors are drawn to China because of, quote, its high-level openness, economic vitality, and expanding consumer base. All those are going to be priorities, by the way, during this upcoming MPC that we're watching. The State Council this week announced measures to attract foreign capital and create a business-friendly environment. And elsewhere, Shanghai Securities News is reporting on the growing popularity of DeepSeek's AI model in the financial sector. I mean, who isn't right now? We just showed all of those quotes from analysts across the banking sector. But yeah, very much a focus in state media today. We see this full-page feature with the paper saying several banks, fund managers, brokerages, they are now using DeepSeek to step up efficiency and reduce costs. It also notes some challenges, though, including the need for employees to learn new skills and substantial infrastructure investment. And it's the latter bit that perhaps is most of interest, particularly when it comes to thinking about the adjacent sectors to AI that are going to benefit from DeepSeek.
Yeah, and as we look for ways that this becomes sort of realized value and monetized. Now, earlier we spoke with JPMorgan Asset Management about the market impact of this broader theme. Have a listen.
And the market goes through periods of optimism around China's ability to innovate, and it goes through periods where the market is less optimistic or more pessimistic. And what we saw in January was just this sort of electric shock, this wake-up call that China can disrupt things still. It can do things cheaper than the US in certain areas. And that's really kind of sucked some of the oxygen out of this story in the US. When things are expensive, in the absence of the fundamentals, if the fundamentals change, you don't have a lot to fall back on.
We're back with BofA Securities China equity strategist Winnie Wu. Just before the break, we were having this discussion about your latest report, essentially positing that this could be the sort of Baba IPO moment for China when it comes to DeepSeek. But just talk us through some of the differences this time. That previous time, a lot of it was US capital. This time we're seeing a slightly different split from the foreign investors that are expressing interest and perhaps, you know, a little bit more skepticism from investors closer to home.
Yeah. Certainly from the investor feedback side, I think, people sitting far away, especially U.S. investors, some of the European investors, they see opportunities in China market more from a structural long-term perspective because positioning is low, valuation is low, peak of U.S. exceptionalism. So they see a reallocation needs from an asset allocation perspective. But many people sitting in Hong Kong, China was surprised by the rally, right? I mean, partly because Hong Kong, China was away on Chinese New Year holidays and missed the initial spike. But also, when you're sitting closer to home, the questions are, how much is DeepSeek going to drive this year's GDP and earnings? Well, not much. How much is DeepSeek driving job creation in the short term? It might eliminate jobs, create efficiency. Is DeepSeek helping with, consumption of multi, going to restaurant? Maybe not really, right? Even on tech names like, when it comes to cloud, data center, the dynamic in China is not the same as in US, right? Because of the competition, the pricing power, things like that. So Chinese investors this time appear to be a bit more cautious about the short-term impact of DeepSeek. And we share the view as well. I think, as I mentioned earlier, it's a 3 to 5 year structural bull story. But there's a 3 to 5 month angle, and there's a maybe 3 to 5 day angle, right? 3 to 5 days, yeah, market overshoot. Market always try to price a 5-year trend in 5 days. Yeah. But reality is, in the next 3 to 5 months, especially, the key things we need to watch, the policy in March 2 sessions. Are there still going to be enough policies to support job creation, birth rate, consumption? Are there enough policies to address China's overcapacity, deflation problem? We need to see, right? And then, March, April earnings season, are earnings missing or beating expectations? Are management guidance turning more positive? High frequency data, like PMI, like consumer confidence. The seasonality in the past couple of years was we had a good first quarter, but things start to deteriorate pretty quickly in April, May, June. Are we going to see the similar seasonal deterioration again, right? And finally, geopolitical tension. So far, it seems to be better than expected, but is the meeting between the two presidents happening in the first 100 days, right? What's the investigation result of these PNTR 301 sections? There's still a lot of uncertainty there.
Yeah, I mean, the DeepSeek fever has certainly covered up a lot of ills in the market. To the point on MPC, do you think the enthusiasm around DeepSeek as, if you think about it, really a success story because of industrial policy, for example, do you think it takes away from the other potential stimulus measures that they perhaps might not announce this time because of the success story of industrial policy, for example?
Yeah, I mean, I think the industrial policy is successful, right? It was correct for China to pivot away from property. Aging, shrinking population, you cannot build your economy purely on property. So I think structurally it was the right thing to do. And what exactly is going to be the new productive forces to drive China, right? We saw that it's EV, it's solar panel, but it turned out that those in itself might not be enough. But the breakthrough in AI could potentially be the big story, right? Because AI can be very similar to internet in the sense that it's a massive 2C industry, right? China has very high mobile internet penetration so that everyone can access AI through their edge devices, right? Access cheaper education, Medicare, entertainment. So I think the AI is probably, the DeepSeek breakthrough is a reflection of the success of China's economic pivoting. But having said that, when it comes to other side of the policy, or other side of structural problem, as I mentioned earlier, falling birth rate, that's a structural problem. And I don't know how much DeepSeek breakthrough is going to help that. And so I think there are still enough policies that China need to do to drive domestic demand and consumption. And even channel check from, for example, the banks in January, it shows that credit demand in January, there's some improvement on property mortgage side. But beyond that, the credit demand in terms of corporate capex, in terms of personal business operating startup loans, demand really remains to be very weak. And China's economy is still very much credit driven. If credit growth doesn't pick up, I still worry about this year's GDP growth.
Okay, so that's a good point about some of these long-term structural issues, plus the need to meet, the GDP growth target. To what extent does the MPC, or is the MPC going to risk what your outlook is for a 3 to 5 year kind of bullish run that is going to be driven by AI? To what extent is that momentum potentially stymied if we don't see enough from the MPC?
Yeah, I think MPC could be potentially a checkpoint of the bull rally. Whether we are 50% of the rally or 90% of the rally, MPC in 2-3 weeks' time will be the first checkpoint, right? If MPC can continue to come up with pro-growth policies and address investors' concerns on consumption, on employment, I think the rally has more legs to go. But on the other side, if MPC take a wait-and-see mentality, which is purely justified, right? Because, U.S.-China policies still have a lot of uncertainty. Currently, we're only facing 10% additional tariff, which is probably better than expected. So does China really need to depreciate the RMB? Does China really need to cut rates 50 basis points? Not sure. Maybe not now, right? So if the NPC fail to come up with more encouraging policies, then potentially the high-frequency data, right, on the economy, the credit data, the earning data, will be a wake-up call and disrupt the current rally. And also, even on, back to your earlier question, on this time, the U.S.-China relationship, how is that impacting investment? 10 years ago, the success of Tencent Baba has a lot of connection with the U.S. VCPEs, right, with the technology transfer. But this time, can U.S. embrace DeepSeek, or will they restrict DeepSeek usage, as we already saw in some states like Texas? Or are they going to ban DeepSeek completely? We don't even know, right? How much will American investors will be allowed to invest in the China AI names? Uncertainty, right? So there are still challenges. So that's why I want to caution that it's a 5-year structural bull story, but realistically, next 3 to 5 months, we might still see more volatility.
Well, do you think the short-term rally we're seeing now, are we through the halfway point, or, I mean, it's anyone's guess, but what's your guesstimate?
I mean, I personally think we are in the final 5 to 10%.
Okay. How does that play into, I'm looking at MSCI China now at 71. Have you rethought some of your index targets because of what's happened recently?
Yeah, I mean, from an index PE perspective, we are now close to 11 times, right? Last October's high, post-reopening high, long-term average was 12 times.
Yeah, we're close to the peak.
Yeah.
Okay, so not yet, I guess, is the question.
Well, again, 3 to 5 days, very hard to call.
Yeah.
Right? But I think, the next key checkpoint, the March MPC will be very important to see.
Yep, March 5, which is 22 days away.
Yeah.
Oh, no. It's Feb 28. No, less than 20 days away.
Keep watching this space.
It is. There we go. Yeah.
Just keep watching.
Yeah, forget my math. Winnie, thank you so much.
Thank you very much.
Nice to see you. Winnie Wu there, BofA Securities China Equity Strategist. You can follow more on the story on today's trading. Our Markets Live blog takes you, of course, to all the commentary analysis from expert editors here across the terminal. We're talking about the stronger dollar. At some point, I might just chime in here on this premium we're seeing A&H shares. So yeah, check this out. Get more context on how your money is moving at this point in time. Plenty more ahead. This is Bloomberg. Right, welcome back. 15 minutes into the cash market session, we're looking at shares of, this is Vanke. These are the H shares listed here in Hong Kong, down to 5.5%. Of course, the big story was Bloomberg has learned that Chinese authorities are mulling this potential rescue plan that would help plug the funding gap worth close to, $7 billion. Let's bring in our team. Our China correspondent, Min Min Lo, is here with the details, along with our Bloomberg Intelligence real estate analyst, Christy Hung, to talk us through the implications there. Min Min, I'll start with you. What do we know about this plan that's being mulled?
So the government is mulling allocating about 20 billion yuan in local government special bonds to buy up unsold homes and vacant land from Vanke to plug a funding gap of about 50 billion yuan. So aside from that 20 billion yuan, Vanke is said to be allowed to look for other financing sources, including loans or issuing new bonds. This came after Vanke warned that it was facing record losses of $6.2 billion last year, and a management shakeup where 2 executives stepped down, and then Shenzhen Metro, the biggest shareholder there, came in to take over the reins of the company. And it's a sign, I guess, a shift in Beijing's stance. This is something they are doing quite differently from what happened when other private companies like Evergrande were facing defaults. Perhaps they are drawing the line here that this is a state-backed company that is perhaps too big to fail. It employs about 130,000 people, and maybe ring-fencing that fear of contagion from spilling over from the private companies to the state-owned ones.
To that point, I mean, this is $7 billion. It's, as far as I'm aware, the first time that local government special bonds are going to be utilised to actually bail out a property company. To what extent is this a game changer for the property sector? And is the local government actually incentivized to do this? Are they going to want to go out and actually sell bonds to save this developer?
Yes, so the program is new. It only started in October. So we do see, a shift in the stance from the person at the top in, trying to halt the housing slump in China. But I think what our worries right now is that, we are all aware of the 300 billion yuan PBOC facility to help local government buy unsold homes. That facility is very little utilized. It's, I think, as of September, in single digit. So local governments, they have their own agenda. And I think the biggest problem right now is affordable housing projects in China is not profitable. In many cases, we're talking about rental yield that is lower than funding costs for the project. So local governments, they are not enthusiastic in doing it. So we will need to stay and watch, are they going to step in and help to buy unsold homes from Vanke to really help turn around its liquidity? Because many cases, they are very selective on the projects. They want the project to be in central area. They want to acquire en bloc fully unsold buildings, and then they want transportation links, etc. So all these added together, local governments, they have been very selective on the projects they're acquiring. So we have a big price tag here, 20 billion yuan, but how much of it would be utilized? Because we had 300 billion yuan from PBOC before, and again, that was only utilized by single digits.
Right, and the temptation was, we take this formula, and the formula is already fraught with nuance, as you point out, right? And apply this to the funding problems of other developers. Is that too big of a jump to do at this point?
I think we, based on the news report, we have assessed a 50 billion yuan funding gap for Vanke right now. And I think the danger is that the 50 billion yuan is just an assessment or a snapshot of what they are facing right now. But if you look at Vanke's contracted sales in January, it's down 43%. So in the worst case scenario, if that degree of decline is going to extend throughout the rest of 2025, we're expecting another over 100 billion yuan sales shortfall versus a year ago. So this is a dynamic concept, and if sales slump is continuing, then the price of a bailout would be bigger. So what we are talking about in the news, 50 billion might not be enough, further down the road. So I think authorities would need to think about stepping up its rescue to really help turn around the liquidity, which is why you're seeing in the share price right now. Today, investors are not convinced. The 50 billion might help to buy time for Vanke, but if we want a true turnaround in Vanke's liquidity, I think more needs to be done.
I'm also curious because your research, you wrote that you're expecting contracted sales to come down by 25% this year, which is significantly higher, I think double of what consensus forecast is. What is underpinning your forecast?
Right, so in our base scenario, we're already expecting sales decline to narrow from the 43% we have seen in January to maybe 20% in the second half of this year. But I think at the end of the day, Vanke is facing a shrinking project pipeline. Land spending last year is down by 88%. So it's running out of project to sell. It's also talking about selling its unsold homes to authorities that would reduce its sellable projects. And at the end of the day also, Vanke has 2/3 of its land bank in China's weaker tier 2 and low tier cities. So those markets will continue to be weak, and we expect further price cut pressure from there. So it's good to have government rescue measures to help it buy time right now, but turning around the operation, we still continue to face a lot of challenges.
I mean, given all of those challenges, when we think about this, what's happened at Vanke, this bailout, is it really a Shenzhen story? And actually, is it really a Vanke story that's not going to be applied to other developers?
Right. So I think Vanke is very unique in the sense that it has 27% stake from Shenzhen Metro. So it has its state link that is different from, for example, Longfor, Seas, and the other private developers that remains to be softened. So I think it's a special exception right here that we need to put a line in the sand in drawing the line in saying that we will need to prevent state-backed developers from failing, because otherwise it would risk spilling over to investors have caution about perhaps Jinmao or USO. These are other government-owned developers. If Vanke is to fail, people will start questioning about the other names.
Okay. Yeah, the fundamental question about moral hazard in China, which has underpinned so much of this kind of repricing of risk that we've seen so far. China correspondent Min Lo and Bloomberg intelligence real estate analyst Christy Hung there. There's plenty more ahead. We'll still be looking at Vanke and this incredible tech rally that we have seen so far. Still watching the Hang Seng Index. This is Bloomberg.
Now, for a look at this tech fever that's effectively gripping these markets right now. So we are in the bull market, of course. We're very close to one on the NASDAQ Golden Dragon Index. We're extending the gains that we saw last night from similar names like Alibaba, Baidu, Bilibili, all saw substantial gains overnight. Exactly what we're seeing right now. I'll even add in King D, of course, which is a software play on this. And yeah, we're extremely close now to topping. We're just 10 points short now of topping that October high on the Hang Seng Tech Index, Robeco.
Yeah, I mean, we have seen a pretty strong rally, and it's really just this handful of names that are being boosted by the optimism around AI specifically. I mean, really interesting comments from Winnie Wu just now about this being something to watch for the next 3 to 5 years, but 3 to 5 days, we might see a pullback. Yeah,
I think she is in the camp that most of the short-term gains are behind us. Maybe another 10% move, but beyond that, we'll need to look longer term. Plenty more ahead. This is the China Show.
Good morning and welcome back to the China Show. We are about half an hour into the session today. Let's just take a look at the HSI, and we are just shy of 1% there, really prolonging this rally that we've seen, driven by, of course, optimism around AI names. Alibaba, one name in particular that has just seen these extraordinary sort of boost up through this week, Dave.
Yeah, Alibaba's back. I mean, it's taking over, social media, FinTwit, as they like to call that community, of course, talking about really, I think on the price overnight, we've taken out the October high. We're very close to that, I believe, here in Hong Kong as well. US Tech Index, to Rebecca's point. And, I mean, visually, right? Check this out. So we're extremely close now to taking out that peak back in October. We are in the bull market as far as that is concerned. I guess a question we need to be asking ourselves, a sober reminder coming out of Winnie Wu, out of BofA Securities, is how much of the gains short-term are behind us, and she thinks most of it is behind us. Perhaps we might see another 10% move to the upside short-term. Longer-term, this is a different story, of course, as we try and model what the revenue boost looks like. But this kind of feels like tequila at 3 a.m. It's epic. It's epic. Oh, it's epic 30 minutes after that, and then we pay for it a few hours after. So just a pulse check, if you will. Okay, a rate decision coming through today in Southeast Asia, out of the Philippines. And markets are looking like this. All but one of the economies that we've surveyed, I think that they're going to follow through with another rate cut today. So from 6.5% at the peak of the cycle, they'll be taking things down to 5.5%. All but one, I think, is also a very good headline that we can apply to the Fed. All but one rate hike is actually left priced in this market when you look at the post-CPI move in Fed Fund futures curve. So that rate cut is actually priced now towards the end of this year. As you can see, though, equity markets are not bothered by it the least bit. Nikkei's up 1.2, the Kospi's up 1. Taipei's up 1/4%. A lot of this, of course, is down to Hong Kong. And massive volumes coming through, I should note here, in this Hong Kong market today. Where we are seeing the Fed effect is still, though, in the bond markets in the Asia-Pacific. The bond self-extending there. Aussie 10-year is up 2.5. The Japanese 10-year, interestingly enough, is up by the similar amount, 2.5 basis points there. So, yeah, This is really down to what we saw from the CPI print and maybe what Jay Powell also said, talking us through the latest CPI print, that the central bank has made progress, past tense, and there is still more to be done. Have a look.
I will say, and I've said before, that hindsight suggests that it would have been good if we had tightened earlier. I don't know how much difference that would have made, but I'd be very careful with those rules. Those rules, those rules in the middle of last year suggested that our policy rate was a couple hundred basis points too high. You know, so we need to. They're a starting point, not an ending point.
A Bloomberg M-Live strategist, Mark Cranfield, joins us from Singapore. Mark, we had a guest earlier. We were talking about the comments from Powell being very backward-looking and really the absence of discussion around tariffs, the inflationary pressures there, perhaps sort of somewhat, you know, being sidestepped or overlooked in the conversation. Just tell us what you make of Powell's comments, and if you think, you know, when you think, I guess, that tariff conversation is going to start being more of a factor.
Well, I think, first of all, he's going to be more concerned about those pesky inflation numbers. Just when you think you've got it beaten, it comes back and bites you. This could be a real headache for the Federal Reserve, regardless of what happens with Donald Trump's policies. If we see the inflation headline numbers creep back towards the 4% level, it really poses a huge problem for the whole Federal Reserve outlook. They are in a situation where they would much prefer to be able to sit on their hands for a long time, see how policies play out, see how foreign countries react if there are going to be any more tariffs and how sticky they are. What he really could avoid, he really doesn't want to see, is domestic inflation picking up in the United States, which obviously those numbers suggest. Now, there's a bit of seasonality about what we saw yesterday in those numbers, but clearly the underlying fact is that they're pretty punchy, and that's not good news for the Federal Reserve, especially at the beginning of the year as well. It won't be too long before traders price out completely any Fed cut. We're only now looking at one interest rate cut for the end of the year, coming around the December meeting, and that could disappear pretty fast as well if we get another couple of numbers in the higher end of the range here. So for now, we're still looking at headline inflation just above 3%. If that creeps up, if we saw a 4% inflation print by the middle of the year, the Fed is in a very tight spot here, because the market would be forcing them to respond. The bond market will not be happy. The vigilantes will be out. They'll be driving yields up through the roof, and the Fed will really be on the back foot. And of course, the US president will probably be looking over their shoulder saying what's going on as well. It's a very difficult situation. They'll be hoping it cools by itself. Maybe the strength of the US dollar will help to offset some of those imported inflation numbers as well. But it's a very uncomfortable situation. It puts the tariffs really into second place here. The immediate problem for the Fed here is, how do we deal with this? How do we keep people calm when the market wants to get carried away with the hot inflation print?
In the meantime, though, Mark, the price action overnight on the S&P, this rally, not completely, but in offloads into the close, this rally we're seeing, excuse me, in the Asia Pacific, and Seng Tech Index, which just a few seconds ago topped and we'll see how we close, the October high. It doesn't seem the inflation story is an equity market problem. When does it become an equity market problem? Does it, Mark?
It becomes a problem when it becomes a problem, as George Soros likes to say. You never really know for sure. In the near term, everyone's much more interested in the AI boost. It's a fantastic story. You can see what's happening with the Chinese tech situation, Alibaba, Tencent, all coming back to life. Everybody loves the idea that DeepSeek is making AI functions cheaper. It's going to be more widespread. That's great for equities in the short term. Equity investors are notoriously short term anyway. They don't care too much about what's going to happen a few months down the road. They just want to get their profits now while they can. The story is fantastic. It's very hot. They're jumping all over that. Inflation story is more of a medium term one. They can worry about that a little bit later. What's more a concern here is whether or not the Treasury market gets out of control. That would probably hurt the equity market story a little bit more. For now, Treasury yields are creeping up. They're not going up too quickly. That may not last. It would only need a few more hot numbers out of the US economy, and the Treasury market could become a bit unstable. That will certainly start to impact what we see in equities. For now, Treasury yields, yeah, they're pretty much in a trading range. CPI is still on the 3 number. It hasn't reached 4 yet. Equity story is very buoyant. The earnings season is coming up here in Hong Kong. People will be pretty excited. They want to know what's going to happen with the big tech companies. We get Alibaba next week, Tencent's a little bit later. But clearly, there's a lot of optimism that people are going to expect a very buoyant outlook coming from these China tech companies. That overwhelms everything. That's the positive story. Equity traders love it. It's like Valentine's Day coming early for them. They're in love with the AI story.
Yeah, 24 hours a day away from that anyway. Mark, and let's hope it stays that way. There's your rhyme for today. Mark Cranfield, MLife strategist in Singapore for us. Still ahead here on the China show. I mean, to the point that Mark was making, right? This honeymoon sort of reigns in the treasury markets. Should we expect it to remain that way? Chow out of Robeco joins us to talk us through her thoughts and really the biggest implications of that Fed print, CPI print overnight in the fixed income space. This is Bloomberg. Right, it's about 20 minutes ahead of the Japanese lunch break, and we're looking at these two, of course, among the many others that have reported so far. These two are actually reporting later today, and of course, there's a broader conversation around this. Is this marriage going to happen at all between the two? 2% to the upside on one, down about 1.3% on the other here. Rebecca.
Yes, elsewhere, we're also looking at Softbank. Softbank shares are under pressure after a bigger than expected third quarter net loss. This, as founder Masayoshi Son also is looking up to shore up billions of dollars in financing for AI infrastructure. Let's get more with our tech reporter, Annabelle Jewellers. Belle, what stood out to you here?
Well, the numbers weren't really great, actually, and I think at a headline level we had a net loss for the period, so worse than expected for the fiscal third quarter that just ended in December. But when you sort of dig into it, I mean, what becomes very apparent is that the concern that we're seeing today reflected in the markets really relates to the Vision Fund, because here it definitely was worse than expected. So actually, investors have been guiding for a profit for that of around 70 billion yen. But instead, it actually came up with a loss of 310 billion yen. So that's quite a miss there. The company is sort of putting that down to the public holdings of its Vision Fund companies, and it says that those lost ground. So names like Coupang, for instance, over in Korea, they're saying that the political turmoil that we saw at the end of last year also contributed to that share price decline. Didi is another one that they signalled out as well. But certainly there are some concerns, even if they continue to build up investments actually in Vision Fund 2, which is the private companies that they hold as well. And so there's a number of those that are looking toward that IPO pipeline.
How does this affect the other issue? Well, the other project, Stargate.
That is obviously was a really big talking point on the earnings call as well, and we know that this is very ambitious. I mean, for someone like Masayoshi Son, you probably don't want to be getting in front of bankers asking for $500 billion when you've just had these sorts of numbers that you've reported. But they are certainly pressing ahead with this. They're very bullish on the outlook for AI. They're very bullish on OpenAI as well, even though they did actually nod to DeepSeek in the earnings call as well, saying that they welcomed these kinds of entrants, even though they could be looking to completely displace models like OpenAI. But certainly, I mean, large language models, they have clearly a ways to go. But anyway, point is, Stargate, they spoke about that. They are going to be deploying $500 billion. We know they want to do that through project financing. They're going to be talking with a lot of different banks, a lot of different investors. But names like Jefferies, for instance, analysts there are saying really at this point that there's no reliable information to judge the potential investment of the joint venture. The returns are really uncertain as well. And so I think you see that reflected today.
Right, Belle, thank you so much. Annabelle Jewellers, our tech reporter. Plenty more ahead here on shows. This is Bloomberg. Right, good morning. What day is it? Thursday. Good Thursday morning.
Been a long week, Dave.
How can I forget? It's a day ahead of Valentine's Day, where florists come out and take advantage of your vulnerabilities out there by gauging.
I know you're well prepared. Okay, don't pretend.
Yeah, we were talking about this yesterday. It's bubble tea.
It's bubble tea.
It's
okay.
bubble tea. Yeah. That's on the more affordable side. Have you guys checked how much a dozen roses are in Hong Kong right now for tomorrow? It's either that or dinner, if you ask me. And sometimes the answer is dinner, right? Any case, let's talk about fundraising. That takes us into this, really. CATL, this planned listing in Hong Kong, is expected to boost IPO proceeds to around $22 billion this year. That's based on some of the estimates, of course, and this is extrapolates, of course, for the full year 2025. We're coming up about an $11 billion year for 2024. That would mark a third year of gains, but certainly, as you can see, and compare that to maybe just the average 2016 to 2021, certainly nowhere near those levels, let alone, of course, the peak back in 2020. But 50 billion, of course, was that fantastic year in equity markets in 2020 here in Hong Kong. Joining us here on set to talk us through the outlook is Aaron Oh, Head of APAC Equity Capital Markets at UBS. Good morning and nice to see you.
Oh, thanks for having me. And again, thanks for starting the conversation with Valentine's Day. I'm sure my wife will be very
plans
happy.
Tomorrow? Big plans?
Well, we have some plans. Yes.
Okay, all right, okay. We'll talk about that later. The markets have been doing relatively better. Good start to the year in Hong Kong, for example. Is this something that has made you guys busier than you expected to be this time?
Yeah, look, I think markets have been off to a good start so far this year. We have elections behind us globally from 2024. And if you look back at what was driving investors and companies last year, everybody's focusing on rates outlook. It was a big election year globally. Yeah. And a lot of that is behind us now. So I think 2024 globally, but also in APAC, it was a year where we're starting to see volumes normalize. Just looking at the numbers in 24, we saw a total of 180 billion of ECM activity across APAC. And if you look at how that stacks up versus historical average, it's really on par with last 5-year, last 10-year average. So we're starting to see normalization of volumes globally, but also in APAC. And I think we're off to a good start this year. We have a strong foundation to see volumes pick up this year. Arguably, we're off to a slightly slower start in APAC so far this year, and that's a little bit of seasonality given CNY is a bit earlier than usual. But certainly, I think the pipeline is healthy, and we're expecting a lot more activity going into Q1 and the rest of the year.
Elections are, in fact, behind us, that's true. But a lot of the geopolitical risk, I mean, just a quick look at headlines, still really ahead of us, particularly this kind of concern over tariffs. We also have this trend around dual listings for Chinese firms. We're still seeing quite a lot of market volatility. I'm just wondering how geopolitical tensions are playing into, are they impacting investor demand? Is the kind of reverse SIFIs, is that a concern for IPOs in Hong Kong?
Look, I think a lot of the headlines around what's driving markets have been there since last year. I mean, the market has never been an issue on the demand side. The demand side of the equation was always there. We continue to see strong participation from international investors as well as retail local investors, and that continues to be the case. So I think the demand side is there. I think the supply side will be interesting to see how it comes together this year. Certainly, our expectation is that supply will be more. And you correctly mentioned around one of the themes that's everybody's focusing on around A2H, which we saw 3 cases last year, expecting to see more of that business this year. And in fact, if you look at the number of companies that's filed, there's significantly more companies that's looking to come to market. Now, I think around timing of the market is, obviously as advisors to companies and investors, we focus around, what's the right timing to go to market. And, in markets where arguably there's, ups and downs, it's our, we always work closely with companies to time the market correctly. And that's something we'll continue to do this year.
To what extent is CATL potentially, we have this 5 billion potentially coming, is that a game changer?
I think CATL is obviously, it's filed publicly. There's a lot of investor interest. I think it's a market where arguably companies that are larger, with good stories, with more liquidity, will do better with more investor interest, and I think that will continue to be the case. That's what we saw last year with a number of very large transactions in Asia. So certainly, I think it's it's an industry leader. There's already a good benchmark in the local market as to where it trades. So we'll see how it goes, but certainly I think it's catching a lot of investor interest, and certainly we'll see more of these larger industry leaders come to market this year.
And outside of the A to H trend, is there any other big theme that will dominate listings here in Hong Kong, or is that largely what dominates volumes?
Yeah, look, I think just maybe zooming out of Hong Kong and looking at more regionally, if you look at the IPO volume, it was lower than historical average, right? And Greater China was a big proportion of why volume was lower last year. We're certainly expecting Greater China to be a bigger proportion of the IPO volume this year, whether it's A2H or more, regular IPOs. And in fact, there's been some good deals that's happened already year to date in the market. India continues to be a very exciting place where we see elevated volumes last year, and I think we're expecting to see the same level of issuance this year. In fact, I was just checking the data. There's 90 companies who's already filed publicly to go public in India, and that's a big portion of our IPO business in India. So look, I think regionally we're expecting to see more IPOs this year. I think with rates outlook being more stable, I think companies are also have a much clearer view as to how they should manage their financing and capital structure. Specifically for Hong Kong, I think A2H will be an important theme, but also I think we're expecting to see more regular IPOs.
And just on the India note, the current softness of the market, I mean, you mentioned earlier it's part of your job to really advise companies when that window is. Are you seeing any reluctance right now for the 90 plus in the pipeline to come to the market? How is the current sentiment affecting?
Yeah, look, I think we're still 6 weeks into the year. Yeah. We still have a long way to go. When the company comes to market will be dependent on market, but also based on their own needs and objectives. IPO is a strategic exercise. There's a lot of different needs that they need to balance with the stakeholders. So I think we're gonna see a pretty even issuance throughout the year. Okay. I mean, arguably some companies would want to go first. Some companies might want to wait until later in the year. But India continues to be a place where there's extremely strong local domestic bid and strong local liquidity. That will continue to be the case, as well as foreign investors who continue to take interest in the country.
Just taking it back home as we finish up here, thinking about Hong Kong, if I understand you correctly, your expectation is we're going to top last year's volumes. Can you give us a little bit more colour on where you're expecting to see that? We, of course, had Gooming coming. Are you expecting, apart from this dual listing trend, are you expecting to see more consumer names?
Look, I think we'll see. I think the beauty of the market today is we're seeing a pretty broad range of companies who's looking to come to market. And it's not focused on TMT. It's not focused on healthcare or consumer. We have a pretty broad range of companies across, whether it's consumer, industrials, tech. So yeah, look, I mean, our expectation is that we'll see a pretty wide range of companies in different industries come to market.
Are you hearing anything about a DD listing?
Well, you tell me.
Okay, I tried my best. I had to do my job. Final word. We haven't talked about Japan. Yeah. Just yet. You covered Japan as well. What do we expect there this year?
Well, Japan was a massive volume market last year. It was. I think the trend, frankly, will continue this year around this cross-shareholding unwind, which drove volume last year. We'll continue to see a lot of that this year. I think we'll see more IPOs this year as well. Maybe sponsor exits, I think, is one theme that we think will be interesting to watch out for. But certainly, I think we'll continue to see follow-ons. Converts has always been a big part of that business there, but also more IPOs.
Okay, Aaron, more IPOs. Thank you for joining us. Fantastic. Aaron Oh, Head of Equity Capital Markets for APAC at UBS. And we're just looking at some breaking news crossing the screens now. Jeff Bezos' Blue Origin bracing for job cuts, David. Blue Origin said to be scheduling this all-hands meeting for Thursday. So I suppose more details are going to be forthcoming.
Yeah, quite some news here. In fact, yeah, we'll get into this and get you more details once they do make themselves available as well. Just speaking of, and we just ended the conversation there just now on ECM in Japan. Just very, very quickly here, we're looking at some of the things going into the lunch break, going into 4 minutes of the lunch break. Softbank, we talked about that with Bell earlier on. Rakuten is up substantially, 14% to the upside, plus, of course, some other things are coming through today, like Honda and Nissan. Just to give you a sense of where we are here on the earnings season-wise, so I think we're about almost, 90% through, thereabouts. 81%. Thank you so much. That's as of right now, a couple of minutes ago. So most have actually beat forecast, 60%. 40% have missed. The market is doing well, very well today. So we'll talk more about this later. Plus, of course, counting down to a central bank decision here in the Asia Pacific out of the Philippines. We are expecting a rate cut there. All things equal, hot CPI print, bad for bonds. Equity markets are undisturbed by that. And this bull market continues here in Hong Kong with the Seng Tech Index now on track to close. Last we checked at the highest in about 3 years. Despite, as you can see, a gloomy day today. It feels like when I was in between two bad exes, really. Rainy day on Wednesday. We are expecting rain again tomorrow. Time to shine again today. We'll see.
It's not as bad as it looks at first glance. I don't think that changes the overall thesis that inflation is basically under control, but I certainly agree with the analysis that this is no reason for the Fed to move in interest rates.
The 2% target has seemed to us to be probably unrealistic for quite some months now. We may now be in a structurally higher inflationary environment than we had been for 15 years.
At face value, this is certainly not good news for the Fed. They will tolerate high inflation without telling us they're doing so. They're just going to keep on promising us that everything's going to be fine. And I think that we are going to be pausing. The pause button is going to be on a lot longer than what the market has been expecting.
We think, notwithstanding this freak out, the Fed's going to be forced to cut rates 3 times starting not this quarter, but next quarter.
Yeah, there we go. Some of our guests here on Bloomberg Television reacting to that, well, hotter than expected across the board CPI print out of the U.S. Core inflation coming through, of course, at 3.3% from a year earlier. So still 3. Hopefully we don't get to 4. I don't want to imagine a world where we get to 4 or even 5 on the 10-year yield. We're currently at 4.6%, slightly lower following the biggest melt-up in yields in months overnight. In fact, just on that note, Asia is still feeling the pinch and pain from that bond bleed overnight with yields across the board. In the Asia Pacific, Japan, highest 10-year yield since 2010 currently.
Yeah, that's right. I mean, to talk to your point about that sort of melt up that we've seen in yields, let's bring in Chow, head of fixed income Asia at Robeco. I mean, let's start with the hotter than expected CPI print, the comments that came out of Powell. To what extent are you adjusting your expectations for the year?
Yeah, I think the expectation of a pause is actually now more consolidated. I think it was always going to be clear that for the Fed to wait for a lot of the new policies to kind of get implemented and see how they work out. So that was going to be like a pause anyway. But I think with this latest inflation print, that just gives more credit to that more cautious view on how to react here. And the U.S. economy, as we've said, has actually held up quite well at these levels.
Yeah. Do you think there's any scenario we could get to close or at or even above 5% on the U.S. 10-year?
I think definitely a possibility if, I said, the numbers continue to be like this and the bond vigilantes kind of get their way. Remember, we still have issuance to come, and some of these policies, which we haven't got clarity on, could really weigh on the fiscal situation. So I think all of those could really push the boundaries, and particularly now, I think, as the Fed's ability to act is somewhat hampered by the fact that there are ongoing policies that are seen as inflationary by the market, but they have actually not been clearly defined yet.
I mean, when it comes to some of those inflationary risks, one thing that we haven't really discussed so far, that we didn't see from Powell, is this discussion around tariffs and what happens to inflation there. I mean, how are you assessing that, and where do you think the risks are for the rest of EM?
Yeah, I think one of the biggest issues we have is that we definitely know there's tariffs, but in which form they take place. And so is it going to be reciprocated? Is it going to be about political alliances or not? Or is it? So there's a whole range of how those tariffs will be implemented that actually obviously has a course on how it impacts. And of course, are we going to get exemptions, etc.? So those are the big kind of unknowns that I think the Fed and the rest of the market just needs to wait for those to come through. For EM, I think
amidst that, go ahead, please.
Yeah, as I say, so amidst that, I think EM countries are obviously bracing themselves for the worst. But as you see, we saw with the first announcement a couple of weeks ago, they could also be reversed quite quickly. So I think these are the things that we have to deal with in this current environment.
I mean, perfect segue really to my next question. The pain in treasury markets has simply just compressed spreads in the credit markets, whether that's Asia, whether that's, in fact, when you look at high yield in the U.S., it's done exceptionally well still. Are there any opportunities right now, amidst what looks to be still a very expensive bond market out there?
Yeah, so I think the whole issue of kind of spreads and yield is really been challenging, I think, for the market. I think particularly because this time around we have somewhat more limited supply from the corporate sector and actually much more supply expected from the Treasury. So I think that's obviously weighing on people. But at the same time, the economic conditions for corporates and the fundamentals of actually, including many of those corporates at EM, have actually remained relatively robust. So I think that's the tension that I think you even talk in the equity markets, that's the tension that the bond market is having to deal with. At the same time of a relatively still right now strong economies.
Tuha, not that long ago, both you and I were really sort of devotedly looking at the China distressed space. And I want to ask you about this today because of this news that we've had about the stale sort of state bailout for Vanke overnight. I mean, to what extent do you think this is a game changer for the sector, or is this just a Vanke story? And I just want to add on as well, where is the moral hazard question playing in here if we see the return of state bailouts?
I think the moral hazard, most of the hazards are dead. So there's not like goodness ready to re-emerge. So I think the moral hazard problem is somewhat gone. I think what has probably become quite apparent now is that some of these structural issues in the property market with oversupply, et cetera, isn't going to go away by themselves anytime soon. And that's why we're struggling with some of the restructurings that are happening within the sector. So I think that's kind of the golden age of like property in China is gone. However, the situation here with Vanke, I think, is more to do with actually, if we accept that there's no rebound in the property market anytime soon, is the government willing to have more kind of distress situations and more uncertainty in the economy where the consumer is already kind of very much subdued with all the tariff fear. So I think this could be less to do with the saving the property sector rather than actually trying to solidify confidence within the Chinese economy, at the same time kind of using the fact that DeepSeek and some of the revival of the equity market to kind of maybe kind of make sure that sentiments do not kind of get toppled over by another default.
Is it too soon, too early to be talking about the offshore dollar bond market as a feasible funding source for property developers? Are we nearing that point where it becomes one?
I think the issue there, even for non-property companies, is actually the differential in yield between the onshore and the dollar market. So I think that is regardless of the property market. So I think, yes, we need to kind of handle the fact that, the funding rates onshore is a lot more cheaper than offshore to kind of before we kind of start that debate again. So I think it is way, way, way too early. We have kind of to talk about that, and actually we need to see the fundamentals on the Chinese property market reviving before we can actually talk about bond issuance at any level.
Are you ready to call the bottom on the China property crisis, or is there a period this year? When do you see that starting to bottom out?
I think it's already been bottoming out, like bumping along the bottom for some time. But I don't see the physical market rebounding anytime soon. I think that is going to take a lot longer for those to kind of the excess supply to kind of be absorbed. So that's a longer story. But I don't think that we may stop going from one crisis to another at this point.
Right. And what are the opportunities now for, say, foreign investors domestically in China, outside of your usual distressed houses, for example?
So, sorry, could you repeat that? So, foreign investors onshore.
So for foreign investors outside China looking onshore in China for potential opportunities, is there something there currently that they can entertain outside of, say, the usual distressed houses who, that's their bread and butter anyway?
Yeah, I think I think there's a lot of reason for the Chinese authority to actually work very hard to make the onshore bond market, attractive again to foreigners. I think both on the government side, but also because there's a lot of supply coming, but actually just to kind of make sure that that funding market comes again. And I think that's where people need to look to. I think. Until we can actually get, so I think some of the names that we look at in the technology and the consumer names, we actually think that those actually still can do quite well. Away from Chinese property, I think the rest of the fundamentals within China is not looking too bad at all.
Chow, thank you so much for taking the time to speak with us again, as usual. Fantastic insights there from the head of fixed income for the Asia Pacific at Robeco. Right, plenty more ahead here on shows. We're just coming off highs a little bit here on the equity markets in Hong Kong. As you can see, we're now just up just under 1%, slightly lower below water here on the mainland benchmark. CSI 300, 3,900. This is Bloomberg.
Good morning, welcome back. Here are some of the world stories we are following this morning. President Trump says he's agreed in a phone call with Russian leader Vladimir Putin to start negotiating an end to the war in Ukraine. That reverses 3 years of US policy on the conflict, with European officials getting no advance warning of the agreement. Trump says meetings with the Russian president are now being planned.
I'll be dealing with President Putin largely on the phone, and we ultimately expect to meet. In fact, we expect that he'll come here and I'll go there, and we're going to meet also probably in Saudi Arabia. The first time we'll meet in Saudi Arabia, see if we can get something done. But we want to end that war. That war is a disaster.
Right. Okay. Let's. Another story, of course, we're tracking here is Israel, and it's said to be pushing to hold on to a handful of its positions in Lebanon. That's after, of course, the U.S. mediators rejected Israel's request to keep the bulk of its troops in the country beyond next week. Now, the reluctance to fully withdraw risks reigniting tensions with Iran-backed Hezbollah, and raises, of course, some hurdles for Lebanon's newly formed government. Right. India takes us next.
Yeah. Indian Prime Minister Narendra Modi has landed in the U.S. for a meeting with President Trump in Washington. They last met 5 years ago, and the mood surrounding their meeting could not be more different this time around. Bloomberg's government reporter Sudhi Ranjan Sen is with us to break down the very latest. Sudhi, just explain the significance and this big shift in context for this meeting.
Well, it's a very, very significant meeting, if you look at it from the perspective of India, because among its key allies and partners, United States is number one. And in every sense of the term, India is looking out for high-end technology, tech from the United States. It's looking out for support to counter China. Of course, India is a very big part of the, of United States policy as well to counter China in the Indo-Pacific. So it's a symbiotic relationship there. Therefore, it will be a very, very significant meeting. And going forward, however, it is not the usual, Indian Prime Minister meeting President of the United States, the fanfare. It's fanfare around it. It may not be as, business as usual. We've already heard that there is a possibility that India could face tariffs. So, it changes the entire game. And mind you, United States is India's biggest partner. And there is a huge trade surplus that India enjoys with the United States. So all those worries will be what, Prime Minister Modi, with Prime Minister Modi. And those are the things that he'll want to address and get a sense of where the India-US relationship will go from here.
Yeah, absolutely. In fact, we're just showing a graphic here, Sudhi, of just the total trade, right? So with the U.S., it's about 127 billion. I want to ask you about, just one point you just mentioned there. How real actually is that risk of tariffs on India?
Well, I mean, we've heard President Trump going up, during the elections talking about India being a big abuser. And also economists who my colleague Dan and I have been speaking to when we were reporting on this kind of say that the tariffs are, tariffs that India has is kind of much more than what the United States, has for India. So there is a ground, and there is, as we have seen President Trump already threatening tariffs not only on India but on its close allies as well. So it is going to be, and it is one of the biggest things that what diplomats here in India tell us is going to be addressed, is what India wants to address, and get a sense of where the relationship, the commerce, the trade and commerce with the United States go from there.
That's Bloomberg government reporter Sudhi Ranjan Sen there. And staying with this theme on India-US ties, sources say that India tycoon Gautam Adani has been building a political influence operation in the US after he was charged over an alleged bribery scheme. Conglomerate media and telecoms reporter P.R. Sanjay joins us from Mumbai with more on this Bloomberg scoop. Just lay out how it is that Adani has expanded this, supposed network of influence in the US.
Like any other conglomerate, it's very natural progression. The Adani camp, their key officials, including Gautam Adani and his nephew, were indicted by Department of Justice. So they are actually leveraging all their relationship, all their might. They have appointing in the legal councils. They are appointing legal experts. They are also reaching out to lobbyists, and they are also reaching out to key officials to get their side heard. And they're very happy. They were with the latest development where Trump promising to abolish or sideline the FCPA, and in the past also they've repeatedly said that they're not part of FCPA and there are no criminal proceedings. And the Adani Group has always maintained that the Adani Group companies have not named or indicted, so the business is as usual. But for the key officials, including Chairman Gautam Adani, they need to get their side heard. So we spoke to the key officials at the Adani Group, and we asked why they have not appeared court yet, and why they have not replied to the indictment done by DOJ. So they clearly said that there was no clear-cut deadline or time frame where they could appear before court, or rather to issue or detailed replies in this indictment. So they are now reaching out. They are appointing key of law firms, and they are also reaching out to lobbyists, and they are doing the best. And this has come all in the right time when Indian Prime Minister Narendra Modi is expected to meet Trump. And what we are picking up is that, of course, there won't be any formal chat on this because it will be a conglomerate-specific issue. But what we are picking up is there will be informal chat on this one, and to get more clarity. And it's very interesting to see this critical issue coming at a very critical and very important visit for Adani Group and for India as well.
Yeah, the two are meeting this week. We just talked about that a few minutes ago. We've seen some commentary from some of the Republican lawmakers framing this specific issue as potentially negative for relations between the two countries. Should we look at it that way?
No, so we were talking to lawmakers here and key officials and analysts and consultants from India. They're very happy because now when Indian Prime Minister Narendra Modi was visiting US, and just ahead of that, the two things happened. One is in Indian budget, they have reduced the tariff for certain items, which is kind of a signaling that India is opening up. India is warmly welcoming the new president and his ideology and vision. That's one. Second thing is that in the US side, they have also trying to do away with FCPA, Foreign Corruption Practice Act, which is going to do good for Indian companies as well. And of course, it will do good for American companies as well. So they see kind of a win-win situation, kind of a level playing field for both India and the US, and definitely that will have a positive implications on Indian companies as well.
Pierre Sanjay, thank you so much. Our conglomerates in media and telco reporter there in Mumbai for us. And, of course, tune into Bloomberg's Linda Amin. In-depth conversation, of course, our colleague there with Asia's richest family in the latest episode of Latitude. Nita Ambani talks about the leading joint venture with Disney, the backing of India's Olympic hosting bid, and, of course, response to some critics here of the lavish wedding of her youngest son. Tune in, 8 p.m. on those times on your screens if you're watching particularly out of Hong Kong and Singapore. Plenty more ahead. This is Bloomberg. Right, welcome back. So this rally is still existing and continuing, although I think the caveat here is we are coming off highs of the day across most. The development, though, in the last, I would say, 24 hours is one, you have BofA flirting with October highs, and also some news here out of Baidu talking about how they're rolling out, for one, I think a new model, and second one, they're making, I believe, Ernie Bot free, if I'm reading that correctly. Yeah, Baidu to make AI chatbot Ernie free from April 1st. And the reason that I have that sort of tone in my voice is April 1st. But that said, don't take what I say seriously as far as what I'm implying is concerned. That's the headline as far as that's concerned.
No, but it does underscore, right, this sort of deep competition between all of these, internet companies now. I mean, we saw them even working through Chunjie, through the spring break, to sort of talk about how they're going to be, for example, maybe integrating DeepSeek and trying to also move their own products to market. There was such a sort of quick jump to it, and there is such fierce competition. And you can see why when you look at how the BofA stock has jumped when it comes to, the last week or so.
Yeah, I mean, there was no holiday, really, for a lot of these firms, right? I mean, to your point, Alibaba released theirs on the eve of Chunjie, right before we went into that as well. And, as more of these companies start to look at what the others are doing and maybe bringing forward some of their strategies, some of their releases, I mean, the same can be said of the market. Some of these strategists are looking at this bull market, and then they're coming out with their own advice. Everyone, UBS, JPMorgan, Morgan Stanley, just earlier on, BofA had come out with also their take on this. We're nearing that October peak on the Seng Tech Index. This is a look over the past year or so, and really how far we've come and come down and then come back up on the way up. So what does it mean? Over the last month or so from the recent bottom, Hong Kong equity markets and the benchmarks are actually the best performing group lot. Hang Seng China, Hang Seng Index, currently outperforming the world, really. And the other two are, of course, in Poland and Slovenia, have done also exceptionally well. Right. Tariffs, let's not forget about that.
Yeah.
And Donald Trump talking about this, and hence we're looking at some of these currencies in play, too.
Yeah, potentially Trump saying that he may sign an order on reciprocal tariffs today or tomorrow. Bit of a question here on whether or not Australia is included in that, because there had seemed to be discussion between the two leaders that perhaps Australia might be exempt because, of course, they are not one of these targets when it comes to these trade deficits that Trump is going after here.
Yeah, I mean, to the point that our guest was making yesterday, it's incredibly impossible to model the impact of tariffs on future earnings and inflation, because we don't know what will last, what will remain in place, and which ones will actually be put in place on that note. But again, uncertainty remains. It's been an inflationary story. The Philippines rate decision today, I'll end with this. Rate cuts is expected out of the Bangko Sentral.